I am Charlie Munger. I am 99 years old. My net worth sits somewhere around the $2.5 billion mark. And I am about to give you a piece of advice that is going to make every single real estate agent in America want to poison my Diet Coke. Here it is. Don't buy a house. I rented my primary residence for over 30 years, from my 40 seconds right through my 70 seconds. I was a renter. Now, understand this. I didn't rent because I was destitute. I was already a multimillionaire. I could have bought the whole neighborhood. I rented because I can do arithmetic. It is that simple. While my neighbors were eagerly signing 30-year mortgages, hemorrhaging capital on property taxes and maintenance, and deluding themselves into thinking they were building equity, I was doing something different. I was taking that same capital, investing it in high-quality businesses, and sitting on my ass watching it compound at 15 to 20% per year. You see, I believe in the discipline of avoiding stupidity, and the current American obsession with homeownership as a form of collective stupidity that borders on psychosis. Let me give you a number that might shock you, though it really shouldn't if you paid attention in fourth grade. The average American who buys a $400,000 house today will pay approximately $1.2 million for that pile of bricks over 30 years. That is the cost when you factor in mortgage interest, property taxes, insurance, maintenance, and the mother of all costs, opportunity costs. You are paying $1.2 million for a house that will be worth maybe $600,000 in real inflation-adjusted dollars 3 decades from now. That is not an investment. That is a bonfire where you burn your money to keep warm. Do you want to know what that same $1.2 million becomes if you had the discipline to invest it instead at a conservative 10% annual return? That $1.2 million invested over 30 years becomes $21 million. One choice gives you a shelter that constantly demands more money. The other choice gives you $21 million in financial freedom. And yet every financial guru, every parent, and every well-meaning friend at a cocktail party tells you the same thing. Buy a house. It's the American dream. You're throwing money away on rent. They are wrong. They are bonkers. And I am going to prove it to you today using middle school math, not emotion. Real estate is the biggest financial decision most people make, and due to a massive psychological failure of judgment, most people make it completely wrong. Let's invert the problem. If you ask someone, how much does a $400,000 house cost? They will look at you like a cow looking at a passing train and say, $400,000. Wrong. Dead wrong. Let me show you what a $400,000 house actually costs in the real world. And mind you, I am going to be conservative with these numbers. The reality is usually much uglier. First, you have the down payment. Most people put down 20%, which is $80,000. That is $80,000 you no longer have to invest. It is gone. We will come back to the tragedy of that lost capital later. Now, you finance the remaining $320,000 at, let's say, 7% interest for 30 years. Your monthly payment is $2,129. Over 30 years, you will pay $766,440 in total payments to the bank. That is $446,440 in interest alone. You just paid for the house twice. You bought one house for yourself and one for the banker. He thanks you for his yacht. But we are not done, not even close. We have to talk about the friction costs, property taxes. The national average is about 1.1% of home value per year on a $400,000 house. That is $4,400 per year. Over 30 years, accounting for property value appreciation, you are paying roughly $180,000 in property taxes. You are essentially renting your land from the government, and if you stop paying, they take it. Then there is homeowners insurance. Average cost is $1,500 per year. Over 30 years, that is $45,000 just to protect your asset from burning down. Then comes the silent killer maintenance and repairs. The rule of thumb is 1 to 3% of home value per year. Let's be conservative and say 1.5%. That is $6,000 per year, or $180,000 over 30 years. And that is if nothing major breaks. But things do break. Entropy is a fundamental law of the universe. A new roof costs $15,000. A new HVAC system costs $8,000. Foundation issues can run $25,000. These things happen, and they always happen when you can least afford it. Let's look at HOA fees. If you are in a neighborhood with an HOA, and most new developments have them, you are paying $200 to $500 per month. That is another $72,000 to $180,000 over 30 years, paid to a committee of busybodies who tell you how short to cut your grass. Utilities, homeowners pay more than renters because houses are bigger and less efficient. Figure an extra $100 to $200 per month. That is $36,000 to $72,000 over 30 years. Then there are closing costs. You paid 2 to 5% to buy the house. On $400,000, that is $8,000 to $20,000. Then when you sell, you will pay 6% in realtor commissions. If the house is worth $600,000, when you sell, that is $36,000 gone in a puff of smoke. Let's add up this lollapalooza of expenses. Down payment, $80,000. Mortgage payments, $766,440. Property taxes, $180,000. Insurance, $45,000. Maintenance, $180,000. HOA fees, $100,000, taking the mid-range. Extra utilities, $50,000. Closing costs plus selling commission, $50,000. Total cost comes to $1,451,440. You spent $1.45 million to own a house. You bought for the sticker price of $400,000. And that is assuming nothing goes wrong. No divorce forcing you to sell at a loss. No job relocation. No housing market crash. No major repairs beyond the 1.5% average. It assumes a perfect world, and the world is rarely perfect. But here is the really painful part. This is where the math gets truly ugly. Let's talk about opportunity cost. That $80,000 down payment, what if you had invested it instead at 10% annual returns? $80,000 becomes $1.4 million in 30 years. The difference between your $2,129 mortgage payment and what you would pay in rent, let's say $1,500 per month, is $629. If you invested that $629 per month for 30 years at 10%, you would have another $1.3 million. So by buying that house, you gave up approximately $2.7 million in investment returns. The house might be worth $600,000 in 30 years. You paid $1.45 million for it. You gave up $2.7 million in investment returns. Your total cost is $3.55 million. And for what? For the privilege of mowing your own lawn and fixing your own toilet. This is why I rented. It wasn't about the lifestyle, it was about the math. Now, you might be thinking, Charlie, everyone can't be wrong. Homeownership has been the American dream for 100 years. And you would be right that everyone believes it. But that doesn't make it true. It just makes it a popular delusion. Let me explain why this myth persists using the psychology of human misjudgment. First, look at the incentives. The real estate industry is massive. There are over 2 million real estate agents in America. Their job is to sell houses, not to make you wealthy, to sell houses. They make 6% commission when you buy and 6% when you sell. On a $400,000 house, that is $24,000 per transaction. Do you think they are going to tell you renting is smarter? Never ask a barber if you need a haircut. Banks love mortgages. It is one of their most profitable products. You are paying them $446,000 in interest over 30 years. They are not going to run ads saying rent and invest. Instead, they want you on the hook. The government subsidizes home ownership through mortgage interest deductions. Why? Because the construction industry is huge and homeowners vote and politicians need both. It is not about what is best for you financially. It is about what is best for the economy and their re-election campaigns. Your parents and grandparents got lucky. They bought houses in the 1,960 seconds and 70 seconds when homes cost 2 to 3 times annual income. Today, homes cost 6 to 10 times annual income. The math that worked for them does not work for you, but they don't realize that, so they give you advice based on a world that no longer exists. They are using an old map for a new territory. There's also psychological bias at play. People who bought houses need to believe it was a good decision. It is called post-purchase rationalization or commitment and consistency bias. They will find any reason to justify the massive check they just wrote. They say, but I am building equity. At least I am not throwing money away on rent. These are emotional arguments, not financial ones. They are rationalizing their own enslavement to debt. And here is the biggest reason the myth persists. People confuse net worth with wealth. Yes, after 30 years of payments, you own a house worth $600,000. Your net worth includes that $600,000. But can you spend it? No, not unless you sell the house. And where will you live then? You will have to buy another house or rent. Real wealth is liquid assets that generate income. A paid-off house generates zero income unless you rent it out. It just sits there costing you property taxes and maintenance. It is not an investment. It is an expense you finish paying for. This is why you see so many people who are house rich and cash poor. They have $600,000 in home equity and $20,000 in retirement savings. On paper, they are doing well. In reality, they are broke. They can't afford to retire because their wealth is trapped in an illiquid asset that they have to live inside. Now, I am not saying you should never buy a house. If you are rich enough that the math doesn't matter, go ahead. But I am saying most people buy for the wrong reasons at the wrong time because they are following the herd of lemmings right off the financial cliff. Don't be a lemming. Do the math. Now, because I am a man who respects facts more than ideology, I will admit there are situations where buying a house is not an act of financial suicide. Even a broken clock is right twice a day, and even a real estate purchase can make sense if the variables are aligned perfectly. But let me be clear, these are exceptions, not the rule. If you think you fit into these categories, you probably don't. But let's go through the mental exercise anyway, just to be thorough. Here's the first situation. You are going to stay in that house for 15 years, not 5, not 7, 15. If you know with absolute moral certainty that you will be in the same city, the same neighborhood, and the same structure for a decade and a half, buying might make sense. Why? Because the friction costs of real estate are massive. Between the real estate agent, the title company, and the government, you are losing $60,000 to $80,000 just to shake hands on the deal. You need time to amortize that misery. But let's be honest, how many people actually sit still for 15 years? The average American moves every 7 years like a cat on a hot tin roof. If you sell in 7 years, the transaction costs alone will eat you alive. You are just feeding the croupier. Situation 2 is simple value investing. You buy significantly below market value. I am talking about buying a dollar for 50 cents. If you can pick up a house for 30 to 40% below market because of a foreclosure, an estate sale, or some distressed seller who needs cash yesterday, the math changes. You are buying an instant equity cushion that protects you from the market's inevitable stupidity. But this requires patience, cash, and a shark's temperament. It is not going to an open house on Sunday and eating free cookies. It is hunting. Most of you don't have the stomach for it. Situation 3 is what the kids call house hacking. You buy a duplex or a fourplex. You live in one box and rent out the other 3 boxes to strangers. If their rent pays your mortgage, taxes, and maintenance, you are living for free. Now you have an asset. But notice the difference. You are not buying a home to play house in. You are buying a business that you happen to sleep inside. That is investing. That is using your head. Situation 4 depends on where you live. In some forgotten corners of America, housing is still cheap relative to income. If you can buy a house for $150,000 with an $800 monthly payment and renting costs $750, the math is a wash. You aren't losing much in opportunity costs because the capital requirement is so low. But let's get real. In most cities where people actually want to live, houses cost 6 to 10 times the median income. In that environment, buying is financial insanity. Situation 5 is the most important one. You are already rich if you have $2 or $3 a million invested and you are financially independent. Go ahead and buy the house with cash. At that point, you have won the game. You aren't trying to build wealth anymore. You are consuming it. Buying a house then is like buying a yacht or a fancy wristwatch. It is a toy. If it makes you happy, buy it. But do not confuse consumption with investment. If you are under 50 and you don't have 7 figures in your brokerage account, buying a house is a giant anchor dragging you down. You have to ask yourself a very brutal question. Do I want to own a house or do I want to be wealthy? Because unless you are a high-income outlier, you cannot have both. It is a zero-sum game for your capital. If you choose the house, you are signing up to spend your prime earning years servicing debt and fixing leaky faucets. You will wake up at 65 with a paid-off house worth $600,000 and a retirement account that looks like a rounding error. You will be house rich and cash poor, the classic American tragedy. You will have to greet people at Walmart until you are 70 because you cannot afford to stop working. If you choose wealth, you take a different path. You rent something modest. You invest aggressively. You let the power of compound interest work its magic. You wake up at 65 with $3 or $4 million in liquid assets, generating $150,000 a year while you sleep. You can retire at 55. You can travel. You can buy a house with cash if you still care. One path gives you a deed to a building. The other gives you freedom. Most people choose the building because they are mimicking the herd. They are lemmings. And like lemmings, they follow each other right off the cliff. So if you are smart enough to avoid the house trap, what do you do with your capital? Let me give you the alternatives that the bank will never tell you about because there is no commission in it for them. Alternative 1 is what I did. Rent and invest with fanatic discipline. Rent a place that is 30 to 50% cheaper than a mortgage. Take the down payment you didn't incinerate, add the monthly savings, add the maintenance money you didn't spend on a new roof, and invest every single penny. Aim for $500 to $1,000 a month. If you invest $750 a month at a 10% return, you will have $1.7 million in 30 years. That is more money than 95% of homeowners will ever see in their lifetime. It is simple math, but it requires the discipline to not spend the money on cars and nonsense. Alternative 2 is the house hack I mentioned. Use an FHA loan, put 3.5% down on a multi-unit property, live in one, rent the others. If you do it right, you live for free. After a year, move out, rent your unit, and buy another one. Do that 3 or 4 times, and in a decade, you own a few $1 million of income-producing real estate. That is building wealth using leverage intelligently, not just using debt to buy a fancy place to watch TV. Alternative 3 is geographic arbitrage. The world has changed. If you can make a high salary working remotely, move somewhere cheap, live where rent is $800 a month while making a San Francisco salary, save $50,000 a year. In 10 years, you have $500,000 plus growth. You are done. You are free. Compare that to the poor bastard in the city paying $3,000 in rent and saving nothing. That is the difference between retiring at 50 and dying at your desk. Alternative 4 is REITs, real estate investment trusts. You want to be in real estate? Fine, buy a REIT. You get the returns, you get the dividends, and best of all, you get liquidity. If you need your money, you click a button. You don't have to wait 6 months to sell a house. And you never have to unclog a toilet. A diversified REIT portfolio can give you 6 to 8% returns plus dividends without the headache of ownership. It is real estate for people who value their sanity. Alternative 5 is land, not structures. Structures are depreciating liabilities that fall apart. Land sits there. If you must buy dirt, buy raw land in the path of growth. Hold it for 20 years. Do nothing. When the developers come, sell it for a fortune. I have made millions doing this. I never fixed a roof. I never dealt with a tenant. I just sat on my ass and waited. Alternative 6 is starting a business. That $80,000 down payment is seed capital. That monthly mortgage payment is operating cash. A successful business can return 20 to 50% on capital. A house returns 3% if you are lucky. Would you rather own a pile of bricks growing at the rate of inflation or a machine that prints money? Every dollar in a house is a dollar starved from a potential business. Houses consume capital, businesses create it. Alternative 7 is the boring one, and it is the one most of you should use: index funds. Put $500 a month into the S&P 500. Do it for 30 years. You end up with $1.1 million. You don't have to be smart. You don't have to be diligent. You just have to be consistent. Most people hate this because it is boring. They want action. They want to feel like they are doing something. They want the pride of ownership. That is an emotional defect. I will take the boring $1.1 million over the exciting $600,000 house any day of the week. The point is this: there are a dozen ways to get rich that are better than buying a primary residence. Renting and investing, businesses, REITs, index funds, all of them offer better returns, more liquidity, and less risk. But nobody talks about them because the ecosystem, the agents, the banks, the politicians feeds on you buying a house. They are parasites on your desire for stability. They sell you a dream, and you pay for it with your freedom. Let me leave you with a story. In the 1,970 seconds, I had a neighbor, nice fellow, an engineer. We made about the same money. We started at the same line. He bought a house for $80,000 with a 30-year mortgage. I rented and threw every spare dime into the market. We would talk over the backyard fence. He would puff out his chest and tell me about his equity, his landscaping, his new patio. He was very proud. He felt like a king in his castle. I listened and nodded and went back to reading annual reports. 30 years later, the results were in. He owned his house free and clear. It was worth about $350,000. He was proud. He had paid off his mortgage. He owned a physical thing. I, on the other hand, had $15 million in liquid investments, same starting point, same time frame, same neighborhood, two completely different outcomes. Why? Because I understood opportunity cost and he understood pride of ownership. Here is the truth that will make you uncomfortable. Homeownership is consumption disguised as investment. You are not investing. You are buying a very expensive lifestyle and lying to yourself that it is a financial strategy. It is not. It is an emotional pacifier. And that is fine if you admit it. If you say, Charlie, I know this house is going to cost me $2 million in lost opportunity, but I love mowing lawns, then fine, buy the house. At least you aren't delusional. But most people are delusional. They genuinely believe they are building wealth. They are not. They are incinerating it. You are trading your future freedom for a psychological feeling of safety today. Real investing makes you richer. Buying a house makes you poorer relative to what you could have had. That isn't my opinion, that is arithmetic. So here is the final verdict from an old man who has seen it all. If you are under 50, if you are still climbing the mountain, if you are not yet free, do not buy a house. Rent something cheap. Invest the difference with religious fervor. Build real capital. You can buy the house later with cash when you are actually rich. But if you buy the house now, you will never get rich. I have watched thousands of people make this mistake. They trade financial freedom for a set of keys. Don't be one of them. Rent, invest, build, and for God's sake, stop listening to people who make a commission off your ignorance.